Being a successful gap trader requires research, discipline, and above all, a plan. When Scott fades the gap, he relies on a strict selection process to help him make his next move. Scott, on the last DVD, you were showing us that while most gaps do fill, there is no easy way to simply trade them all and profit from them all, right?
Unfortunately, that's correct. There is no easy way.
All right. So what is the secret?
Secret is selection, being very picky. I like to focus on the gaps that have the highest probability of success, and even more importantly, I like to make sure I avoid the riskiest setups. So I use what I call my 4-filter process. I know it sounds a little dry, but it works, and that's what we're going to talk about now is those 4 components of selection. Zones, which is what I'm going to talk about right now, market conditions, patterns, and seasonality, which we'll get to after the all-important opening zone.
Okay. Well, eliminating the most risky ones, seems to make sense.
It does. So, that is the key.
And we'll figure out how we do that.
That is the key. So first and foremost, the zone. And let me break down what I mean by zone. I'm talking about gap zones. When I use that term, I'm talking about where the gap opens relative to the prior day's open, high, low, and close. As you can see on this daily bar, if you will, those 4 levels form 5 potential zones where a gap could open on a given day. So as they say in real estate, location, 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 well, with gaps, that applies also. They work for several reasons. First and foremost, they are very well-known levels. They are used by floor traders in Chicago in the pits. They're used by traders of all different time frames. Those are very important key levels. No matter whether you're a short-term trader or a long-term trader, just about everyone knows where the open, high, low, and close was for the prior day. So it's not a calculated level like a floor trader pivot or a Fibonacci level, some of the more technical terms. It is an actual fixed known price level, and often it will serve as support or resistance for the next day.
Yeah, I mean, it's pretty black and white. You know where it closed, where it opened, what the high was, what the low was.
That's it. And I use those key levels. My research has determined those key levels make a huge difference in terms of delineating the winning gap fade setups versus the more risky setups. But there are other factors to consider also, like the size of the gap is inherently built into the zone. If we open above the highs when the prior day was up, like in this example, that's going to be a smaller gap most of the time than, say, a gap that opens below the low of the prior day. So that's another reason these zones work. They inherently incorporate gap size. And they also incorporate trader psychology, which I'll talk about a little bit more in a moment. But just to be totally clear, because this is the foundation of what's worked very well for me, and it's a great methodology to apply to any instrument, whether you're trading a stock, an index, a commodity. You can use this exact same process, and it will help you better segment your trades and better analyze them.
Every piece of the puzzle is crucial, obviously, but figuring out how you select the trade is obviously probably the most crucial part of it. For gap trading it is. For gap trading it is, because as we've already talked about, or I should say we will talk about, the stop isn't as important, for example. You have to have one, but it's not nearly as important as where that gap opens. That's going to determine the probability of having a winning gap trade and whether or not you make money or not. So on this slide here, we're talking about gap zone areas. There are 5 different levels, as I just mentioned. We can open above the high, between the high, and if the day was up, it'd be opening between the high and the close. There in the middle of the body, you're opening between the open and close. And then all the way down to be opening below the low of the prior day. So that forms 5 zones. And let me just continue. Remind you, all gaps historically have averaged more than 70% historical win rate. And this is using a minimum size of 1 point. So eliminating all the tiny nominal gaps, looking at gaps more than 1 point in the E-mini futures, that's equivalent to about 10 cents in the SPDR, the ETF. So anything more than that, historically, it's been about a 72% win rate. But when you break it down by these 5 zones, you can start seeing how the extremes, as one would expect, have a slightly lower historical win rate. And I want to be really clear from a definitional, if that's a word, definitional perspective. From a definition perspective, this assumes that one would fade the gap at the open and then close it at the end of the day or at gap fill.
So it's an end of the day stop. That's what these numbers show here. So that's giving a lot of liberty to the trade to actually work. And historically, 72% overall. But the lowest historically is anytime a gap opens below the low of a prior day. Just period. Just remember that. That's going to be a risk factor. But taking this concept a step further, and if you actually break down the day into was it an up day or a down day, as defined as the difference between did we close higher than where we opened or did we close lower than where we opened, then it allows you to take the same concept and go from 5 potential zones to a total of 10. Now, that may sound like too much, but let me show you how the math plays out when you actually break down historically all opening gaps in the S&P 500 based upon these 10 potential zones. The scenario on the left is the prior day was down. You can see the top left, if prior day was down and you gapped up the next morning and opened above the prior day's highs, about 60% of those gaps historically have filled the same day. So that means the price action would be up here, way up here, and then it would retrace back down to that thick dotted line, which is the prior day's closing price. Now, if you happen to gap down just a little bit the next day, and this is where my mouse is showing the arrow, 77% historical win rate. Quite a big difference, almost a 20% difference.
Yeah.
So on the far right, if the prior day was up, you can see, again, great differentiation in terms of these probabilities. If you gap down below the low of a prior up day, 55%. That's barely a break-even strategy from our win rate perspective. Now, that's not the whole part of the equation. Many of these gaps are large, but I personally like to stick with the highest probability setups. And you can just see the difference. I mean, for example, if the prior day was up, the single highest probability gap fade that exists when trading stocks and indices, just about anything I've ever tested, is in this zone right here where it has an 80% historical win rate. And that's when the gap opens just above the prior day's close, and the prior day was an up day. So those tend to be smaller gaps. The move's normally a little bit exhausted. It'll retrace back to the prior day's closing price.
And just to clarify again for the viewers, you mainly trade this on the spiders and also the E-mini S&P, right?
I mainly trade the indices. I mostly focus on the futures. A lot of folks trade the same methodology. They trade the spider, the ETF, but also I've done lots of research on the Qs and the NASDAQ futures, their corresponding instrument, the diamonds, which is an ETF for the Dow, and the corresponding YM, which is the E-mini Dow. And I've also done it on the Russell and the Russell 2000 ETF as well as the futures. The numbers are remarkably the same over the past 10 years. So it's a very robust strategy. And I want to be really clear again, and I may be repeating myself, but whenever a gap occurs in one of these zones, maybe you're not trading this instrument. But if you are trading a stock that tracks with the NASDAQ or tracks with the S&P 500, that's called beta, your coefficient of correlation. But if it tracks, it tends to move. Whenever the S&P goes up, your stock tends to go up, your favorite stock. Or if the S&P goes down and your stock tends to go down as well, then you can use that same concept and say, well, gaps are probably going to react in the same way as the broader index. And that's a great technique that a lot of people do.
All right.
So that's the concept of zones, and they're an extremely powerful one, not overly complicated. I started by creating zones and studying zones by downloading data across a large number of years, across a variety of instruments, and testing that way in a simple Excel spreadsheet. So here's just a tip, and I'm going to talk more about this. This is one of the patterns you just got to remember, so that's why I'm going to reiterate it. But anytime you have a gap down below the low of a prior up day, in this example here, we call that a blood gap below the low of an up day. I know I'm from North Carolina, but I also know that is misspelled. But that's an acronym, below, low, up day. And it's just an easy one to remember. It's about a 50-50 historical win rate for fading gaps that open in that zone. So
you're from North Carolina, but you are a Tar Heel and not a Wolfpacker.
That is true. I'm a Tar Heel. I'm actually a Virginian that relocated to North Carolina.
Well, lucky for you. Yeah.
Yeah, we do a little better in basketball in North Carolina than Virginia.
All right. So again, BLUD is
blood gap below the low of an up day.
Okay.
And it's just a great tip. I'll talk a little bit more about it later. But
avoid.
Yeah, well, actually, you know what I'm going to do? Because we've got the chart up right now, let me talk about the psychology that goes on. So imagine you're a trader and you have bought maybe prior to this day, or maybe on this day that's a big green candle, you think the market is going to continue its march upward, and you are long. The next morning you wake up, you scream when you see that the gap has opened below the prior day's lows, because that is a very important level. You've probably tightened your stop up near those lows. You know that other folks are going to be covering their longs, and you cover a position, meaning close a position, by selling it. So they're going to be selling, putting downward pressure on it at the open. On the same token, you're going to be attracting new short sellers. So a lot of folks, a lot of institutions that short the market, trying to take advantage of potential changes in trends. You may think this is a breakaway trend, a breakaway gap, and they're going to be jumping on board, putting downward pressure on the market. So those two combined forces sort of put a lid. It doesn't mean the gap can't fill. As I showed you, almost 50% of those gaps will fill, but it makes them much more difficult to fill and less likely to fill. So I, as a gap fader, like to stay away from fading those gaps. All right, so the next key to success from a selection point of view is looking at the market mood. Market mood is just my way of describing market conditions, essentially. Okay, we've looked at zone, and now I like to look at market conditions. Has the market been generally bullish, bearish, or somewhere in between? That can give you lots of insight and clues into the probability of an opening gap filling or not. So, sort of a busy slide here, but I think it's a worthwhile slide, and it'll drive home the point using data, because I don't like you to take necessarily my word for it. I like to support everything I do with data, because that's how I get my clues to the market. This slide here shows you essentially that the curving line is a 200-period daily moving average. Okay? And what this slide shows you is that when you've had gaps that occurred above the 200-day moving average, that top left-hand box, whenever it's gapped up, that would be a short. That's happened about 800 times in about an 11-year period this was done. Almost a 74% historical win rate and a profit factor of 1.23. So remember, profit factor is simply the ratio of historical profits divided by historical losses. And 1 is a break-even strategy. So this has generated almost 25% more in profits than losses historically. Mm-hmm. That's using an end-of-the-day stop. So that's a really large stop if you think about it, and it's still a very profitable strategy. So when prices are above the 200-day moving average, and you're trading something like the S&P 500 or another related index, you want to be seriously considering shorting those up gaps in that scenario. Now, if you look at the when it gaps down, there's only about 677 that happened during this time. So it still happens frequently. A little bit less. There's only a 2% drop in win rate. And you may say, wow, that's not a big deal, Scott. Yes and no, right? I mean, if you can save 2 percentage points here, 2 percentage points over here, you identify another 5 percentage points. Before you know it, you've got 10 of 15, 20% difference in probability. And that, from a mathematical point of view, and more importantly, from a trading profitability point of view, is a monstrous difference. So, and I'm pointing this out just to start showing you, teasing you with the idea of the importance of using something like a moving average to start discerning the differences between market conditions. So, not bad though. The down gaps when you're above a 200-day moving average, profit factor a little less than 1, 72% win rate, pretty much a neutral break-even strategy. But if you look over here on the bottom right, below the 200-day moving average, it's the opposite scenario. The shorts actually do worse. They have about a 67% win rate, almost a 68% win rate, and a profit factor of 0.87, the lowest of all of the 4 combinations there. And the longs actually do surprisingly well. So one of the questions I get a lot on this, Tony, is why in the world would shorting a bull market work better than buying the down gaps? Aren't you supposed to buy pullbacks, and vice versa? Like when the market's selling off and you're in a 200, below the 200-day moving average, that's considered a bear market by many standards. It's a weak market. Don't you want to be shorting, right? You're taking advantage of that little bounce, the dead cat bounce that you hear people talk about, and you want to short it.
Right.
It doesn't work that way. And I really believe it gets down to the psychology of what's going on with the market participants. When the market has been roaring, it's roaring because people are increasingly bullish. They're buying and buying and buying. So if you are very interested, you're a big fund, and you're interested in buying the market, do you want to buy when the market has gapped way up, way above the prior day highs? No. You're paying a premium. You want to wait till market pulls back some. You want to buy some weakness. You want to wait till that gap fills to buy it. So often the pros, the same people that have been bidding the market up, when you get that big gap up during a bull market, they're going to be shorting the market right at the open. They want prices to go down. They'll make money going down, and they'll buy it all the way back up. And I know it's a little counterintuitive.
That's the old, buy the dips.
Right. That's what they want to do. They want to buy the dips. They don't want to chase. Do you really think some of those big name firms that I won't name, but those big brokerage houses really want to be paying premiums? No way. Not with the size of their trading. So the other concept from a psychological perspective that I want people to understand is that when you're below the 200-day moving average and you get a gap up, so you're in a bear market, you think you want to short those up gaps, and it's a very common, I don't even want to say it's a rookie or an amateur move. A lot of very experienced traders get caught on the wrong side also, thinking, oh, this is a good opportunity to short. Doing the opposite of buying the dip, they're shorting the strength because we're in a bear market. And what happens, though, is that the market has been selling off, selling off, selling off. And that first big gap up, what are people doing? The shorts are covering their longs. And you cover a long position, meaning you close that position by buying it.
Right.
So they're putting buying pressure on that big gap up the next morning. Now, are they going to re-enter at some point? Of course. But they're probably not going to re-enter right at the open of that big gap up. They're going to wait till the market rallies some more, bid the thing up, get prices really high again so they can slam it back down. So a little bit counterintuitive. Trust me, the data is correct. I've done lots of research on this, and this is essentially the foundation of how I have approached discerning market mood or market conditions. So I'm trying to identify which conditions are ripe for fading an up gap versus fading a down gap, and this is an example and a good place to start right here with the 200-day moving average. So this essentially summarizes what I just said way more succinctly than I did. When price is above a 200-day moving average, you want to be fading or shorting up gaps. When price is below the 200-day moving average, you want to be leaning towards looking at the longs and being very careful with shorting the up gaps. Now, what I've also done, and I'm going to show you an example, is you can add other moving averages. Why not use some shorter moving averages, and let's break the market down into smaller chunks, but that are more specific.
Yeah, you have 200-day moving average on there, but a lot of traders like to look at a 50-day moving average.
Exactly right. 50 is a very common one for swing traders, long-term fundamental traders, even day traders like to pay attention, where are we relative to the 50-day moving average? Is it sloping up or down? So this slide here actually shows and let me get the year right because I think it makes it a little bit interesting. This is part of history that will be captured forever. From February of 2009 till about August of 2009. So this past year, from the time that we're recording the DVD, this is the bottom of the monstrous sell-off from 2007, that history-setting sell-off and bear market when the markets were imploding, putting in their low at the beginning of March.
This should stand in history for a while.
For a long time, this will be an important, and that's one of the reasons I wanted to capture, because it was such an insanely intense time. This is when the market, this bottom, I'm not predicting that the bottom is in for good, but we're well off of it now. This could be the bottom that may not ever be seen again, literally. So at least that's what we all hope, right, for the markets.
Or at least not again in our lifetime.
Exactly. What happens after we're gone doesn't really matter as much. But what this shows you is for that period of February to August, that's what, roughly 6, 7, 8 months, I've got 3 moving averages on this chart. The skinny line is, I think it's yellow or gold, is a 20-period moving average. Let me just point that out with my cursor. See it curving down, that it moves the most. That's the 20-day moving average. The thicker blue line is the 50-day moving average. And the even larger pink or magenta line is the 200-day moving average. Okay? So you can see we've got, if you look at the different combinations of or placement of where the 200-day is relative to the 50, relative to the 20, we actually have 6 different market moods as I'm defining them here. And let me just point them out because I'm going to show you a chart that really breaks it down, but see if I can do this without messing it up. So if you go from far left in February, you had the 20-day was below the 50-day, which was below the 200-day.
Right.
Make sense?
Yep.
And it stays that way until over here in April when the 20 crossed above the 50. Now you have the 200 above the 20 above the 50. Stays that way all the way until we get over here in June where we have the 20 above a 200, which is above a 50. And then it switches again when that 200 goes beneath the 50. You got the 20 above the 50 above the 200. And for a little bit of time there, that 20 dips below the 50-period moving average while both of them are above the 200-day moving average. So that's actually 6 different relational combinations, just 6 different ways to look at the market over a really important time in history. So what I'm going to do now is show you the history of fading gaps through those 6 different market moods, if you will.
So we have to identify what kind of market we're in to help identify what trade we're going to take.
Exactly. You're trying to figure out where are the best setups and which ones are the ones you want to stay away from. The good thing with gaps, and again, this is a subtlety, and I say it a lot, but it's so important. The good thing with gaps, the bias is for most gaps to try to fill. More than 70% historically will fill. The key is to try to avoid the majority of the losers. So even if you goof up and take some of the marginal setups or you're not sure, you can be a little bit aggressive and get away with it often with gaps because they have a bias or tendency to fill. So using data like this, you can literally print this out and use it as a reference point. When should you be very careful with which type of gap? There are up gaps and down gaps. So I'm not going to go through.
You say the gap fills 71% of the time. Historically, it fills 71% of the time. So you instantly think, well, that's pretty darn good. This, how hard can it be, right?
Right.
But then you have to think, like every other trade style, there's more to it than meets the eye, right? You have to know when to get in, when to get out. Some of it's based upon your stop loss and things like that. But the 71% is pretty, that's a pretty impressive statistic on its own.
And as I mentioned, that's why I love the gap fade. I think it's the easiest, highest probability setup, and I think it's a setup that will benefit more traders than not, regardless of your experience level. So the key is, if 71% fills, how do you make money? We're going to talk about stops and targets and entries a little bit later, but the key really is the selection process. That's the easiest way to make money. Just avoid the majority of the losing setups. So what you see here, I'm not going to go through each of these lines, but if you see red, these areas circled in red, you can see that the win percentage, especially these two right there, 63% and 67%, those are both up gaps and down gaps when the 50 period was above a 200, which was above a 20 daily moving average. Now those numbers may not sound too bad, but that's an end of the day stop. And that is almost 10% lower than historical norms. But look at the number to the far right. That far right column, profit factor, historical ratio of profits to losses, less than 0.5. That means fading gaps, up gaps, when the 50 was above a 200, which was above a 20, has lost more than twice as much in profits as it has made historically during similar setups. So that is just telling you are playing with fire if you are trying to fade that selling or shorting an up gap in that condition. In fact, if I may, I'm going to go back to the prior slide and we'll look at that 50 over the 200 greater than the 20. Fortunately, it doesn't appear to happen much. It's only actually happened 60 times in about a 10-year period, but you want to watch out for it. When the 50, in fact, there was this little blip right here. The 50 was above the 20, which was above the 200. Now, it was only 1 or 2, so this wasn't a great example, but it doesn't happen that much. But it's a kind of scenario where you want to be careful. The market is unstable. So let's go back to the chart. So now let's look at the actual historical probabilities for fading both up gaps and down gaps based upon those 6 different market moods or moving average combinations, if you will. So it's sort of a busy slide, and I'm not going to go through every line, but what I want to impress upon you is that this is all about the data. And if we can identify the best scenarios while staying away from the riskiest scenarios, that is a tremendous advantage for a gap trader. And these different moving average combinations, essentially the way I think about it is that they represent when the market is more stable or less stable in what the bias is. So, for example, one of the best scenarios right there across the top is when the 20-period moving average is greater than a 50, greater than a 200. That's a strong bull by my definition. Happens frequently. Win rate is almost 80%. That's a nice 8% kicker above the averages, and the profit factor is 1.31. It's generated more than 30% more in profits than losses.
That's the one we want.
We want those. Those are great. Unfortunately, they only happen about 20% of the time.
You don't get it all the time.
No, you don't. But you want to be aware when you're in that kind of environment, and you want to be focusing on those up gaps. Down gaps aren't bad. You can scroll down and look at these at your own leisure, but what stands out in the middle are some risky setups. 50 greater than a 200, greater than a 20. I call that a neutral bull. That's actually a pretty unusual scenario because you see the sample sizes are around 60, a little bit less than many of these others. Win rate 63 to 67% for both up and down. Profit factor, wow, 0.43. That tells you it's lost more than twice as much as it's ever made fading those 60 gaps. So you just want to stay away from those. Scrolling down a little bit further, here's one that stands out with the best profit factor of them all. If you look down the profit factor column, number one most profitable scenario is right here. The 20 above a 200 above a 20, above a 50-day moving average. That's called a weak bear, and it's fading up gaps. Happens a fair amount. Win rate almost 80%, 78%, but look at that profit factor. 1.61 has made 60% more in profits historically than it has lost. And that's what you're looking for. You want to be trading those setups aggressively while staying away from those other ones. So let's go back to that prior chart, and I'm going to show you what it looks like on a chart and the kinds of gaps that you want it to be shorting,
all right,
fading.
The win percentage is about the same as the other one, but the profit factor much higher.
Much higher. So in this scenario, you've got the 200-day moving average, and the 20 is above the 50. So you've had some strength. It hasn't been just a big sell-off. You've got some strength. The market's recovering, as you can see just right there as it was in April. You're still in that bear market, but there is some strength. So what happens on those gaps up? Even though you're below the 200, which often can be a riskier time to be fading an up gap, because we talked about that in the prior slide. In this scenario, the market's starting to recover, and as you're approaching the 200-day moving average, the bears are getting more and more aggressive. They're starting to sell more and more. So it's a great opportunity to actually be shorting those up gaps. And you'll often get some big up gaps because the market's transitioning. It was bad. It's improving. And now you've got the longs, the shorts are now covering and pushing these gaps up, but then the sellers are showing right back up because you're still below the 200. Yep. So makes a big difference. Historically, it's done very well, decent sample size, and you can see most of those gaps. If you actually drill down closely and look at these gaps, most of those gaps filled that were up during that time. So let's go back to the table.
So this is telling you that one of the ideal market moods or market conditions is really a bear market.
Absolutely. Bear markets work great. And well, quite frankly, if you look at the numbers, there are very good scenarios in a bull market, very good scenarios for a bear market, and there's some that are less attractive in both.
All right, so let me ask you this. How hard is it to recognize the type of gap early enough in the day to trade it appropriately and profitably?
Oh, good question. So not that hard with the way I do it, because my emphasis is on trying to enter at the open, because, and I'm going to talk more about the advantages of doing that, but I'm trying to replicate historical norms. So what I've done is I've created all of my, the bulk of my effort is based upon using the prior day's information. So because I know where we close, so in this example, I know at the end of the day whether or not the 20 was above the 50, which is above the 200. So I know where we are at the end of the day, which market mood we're in. So depending upon whether the market gaps up or down, I can take advantage of that scenario. Does that make sense?
Yes, but one piece of the puzzle is where does the market open, and you're basically jumping in right at the open. So
right. So what I use futures. If you are trading a stock that doesn't trade overnight, then you do need to have an idea of where the market may open. So you can track the futures and get an idea as the market could be up or down. I mean, even the various newscasts will have the markets, the futures up or down in the morning. So you'll have an idea where that stock is likely to open. You also, you'll have your gap zone map. Those zones that I just went through, have those printed out in front of you, and you can determine where we're opening. You'll have the numbers. You see exactly where you open. What zone are we in? You already knew whether or not you were more interested in shorting an up gap or buying a down gap based upon market mood.
All right.
And
well, so far it's mostly numbers. It's mostly numbers, but what about patterns? Does each one have a specific pattern?
Well, sometimes they do have patterns, sometimes they don't. But I certainly watch for patterns. That's a great segue here into the third element of my selection process, are called patterns. There are different types of patterns. Single and multi-day chart patterns can get pretty complicated. In fact, hundreds of them that I've studied, and combinations of them go probably into thousands. But there are many, many different patterns. The location of the prior close is really important. So patterns based upon the location of the prior close compared to the prior day, and location of the opening price. So there are different types of patterns. I wouldn't worry too much about the categories, but just the concepts. You want to look for some of the best patterns, and you want to stay away from the risky patterns. There are way too many patterns to go into, but once you get used to tracking them and you know what to look for, they're pretty easy to stay in tune with. And I'm going to point out some examples of some of the very best patterns and some of the worst patterns that you should pay attention to as a gap trader. So let's look at risky patterns. I'm going to sort of build these slides so you can imagine the scenario. So the prior day could have been an up day or a down day. That's denoted by the white body of the candle. And an S1 pivot, in case you don't remember what that is, or you're maybe not familiar with the term, pivot is a calculation based upon the prior day's high, low, and close levels. And it's a very common term used by many traders. There are traders that, just like I consider myself a gap trader, there are traders that consider themselves pivot traders, both day and swing. But I do look at pivots on the gaps, and I like to pay attention to where the gap is opening relative to that pivot. The S1 pivot, if you're really geeky and want to know what it's made of, it's simply the high-low close divided by 3, subtracting the prior day's high price. But you can Google that and find that out. The key point is pay attention. Does the gap open above or below the S1 pivot? And if it opens below it, you want to stay away from those gaps. They are generally riskier. One, it implies they're generally larger gaps to open down below that important technical level. And because it's an important technical level from a psychological perspective, there are going to be many stops sitting there. There are also going to be many short sellers sitting there as well. So that combo deal, so like the blood gap, where you've got folks covering their long positions by selling, and new short sellers showing up.
Yeah, and I was just going to ask you that. You talked just before about the blood gap being dangerous, or to avoid that. So this kind of goes along with that.
Yeah, so think about it this way. And remember, I'm filtering gaps by putting these pieces together: zone, market conditions, patterns, and seasonality. So if we are opening in the blood zone, and we open not only below the prior day's lows, which of an up day, that's the blood gap, but we're also below S1, that's 2 strikes against a gap. Simple enough, right? You got 2 strikes, you definitely got to stay away from it. So doesn't mean that it's not going to fill. Doesn't necessarily mean you can follow that gap either. A lot of, the other technique is to follow the gap, go with the gap. But it certainly, if I was going to pick a direction, you want to be following that gap, not fading it, at least from my experience and from the research shows. So that's a gap opening below the S1 pivot, but don't take my word for it. Let me show you some research that supports it. So it's impossible to gap up and be above S1 because the way it's calculated, you can only be below it. But this is the raw historical win rate for fading gaps. They have to be a down gap, meaning so you're buying those gaps, targeting the prior day's close price. And the S&P futures, which is the ES there, 55% historical win rate, very similar to the blood gap number. And for the Qs, it's 60%. So confirmation, the Qs is the ETF, technology-based, and I've checked it with others. Definitely a risk factor buying those down gaps. Make sense?
Yes, sir.
All right, so that's gaps opening below an S1 pivot. You can get you don't have to do the calculation yourself. Your broker will have that information available for you. Many websites will have that information as well.
Oh, go on now. We don't even have to do that ourselves?
You don't have to do it yourself.
Right.
You can. I'm actually retentive enough. I put it in an Excel spreadsheet and calculate my own pivot levels, but you don't.
If only you would have done more research, Scott.
I've done enough, believe me. All right, so let me give you an example before I go. So just so you can visualize it, this is on a 5-minute chart in the spider. The top gold horizontal line is the prior close, and the next horizontal gold line is the S1 pivot. Again, that calculation I just described. The next morning, it gaps down quite a bit below it and doesn't even make it back up to it. It just starts selling off immediately. And it's because you've got that excessive downward pressure. You have more sellers than buyers at that price level. Mm-hmm. It did hang in there for about, what, 15 minutes? Looks like two candles that hung in there. And then you get that big third red candle, and it just keeps on trucking to the south side. So great example. This would have been an awesome setup to follow the gap.
Yeah, looking at the chart, I mean, you see that now, but you're saying that when you identify that, that doesn't necessarily mean that it's a follow the gap play either, right?
It doesn't necessarily mean but if you have other confirming factors, then it probably is. But just because it opens below S1, you want to be careful, because remember, even the gaps that open below S1 can fill the gap. I just showed you 55 to 60% will fill the gap that day. It's just a 50-50 kind of play. And as a high probability based gap trader, I'm looking for much better odds than that. And I think you should too if you want to be a successful gap trader. All right, so let's look at the opposite of gapping below S1 is opening above R1. Doesn't matter what color the day was. It could be an up day or a down day. And you've got the calculation of R1 for those gamers that are really interested. High-low close divided by 3. That calculates the daily pivot. And then you subtract, I take them back, high-low close divided by 3, and you subtract the low of the prior day. So then you gap up above that, and that is a problem.
So that's also a no-no.
That's a no-no. You don't want to fade those up gaps in general. Now, this is not looking at market conditions. I'm isolating the scenario right here, opening above that daily R1 level. And the reason is, just like, as I mentioned before with the S1, it's the exact same concept, just in reverse. There's a change of market sentiment that's likely taking place with that gap. Stops are going to be run, and you're going to attract new buyers in this case that will work against your gap fade, so you want to stay out of harm's way. Here's the data that supports it. Historically, gaps opening above the R1 pivot, they have to be up gaps by nature. In the ES, 62% of those fill, so still a 6 out of 10 shot, which I know doesn't sound that bad, but that's using an end-of-the-day stop. You put a stop on there, it's a 50-50 kind of play. The Q's a little bit worse than that, and it's just one that I like to stay away from. Now, I want to be clear about something. Does this mean I would never, ever fade a gap above R1 that opened above R1? No. It does not mean that. In trading, it's very rare that I would ever say never. But it just tells me my inclination. If I know it's going to be a big up gap, it's going to be above R1, everything else has to be lined up perfectly. I mean, it's got to be really close to R1, so it looks like it's going to open right at R1. I've got to have market conditions on my side. I've got to have seasonality, which I'll talk about in a moment, and I've got to have that opening zone has got to look like it's a good setup for me to consider it. So there's a chance, and I can almost guarantee you I would reduce my position size. That's one of the ways I do.
Well, that's what I was going to ask you. This would be a red flag, but then if you had enough green flags, you may still consider it, but you say, okay, I'm going to take it, but with a smaller position. Great
analogy. Is exactly right. Exactly right. That's the way I do it. Some people are even pickier than I am, and they won't even trade it at all. And often I won't trade it because normally if it's above R1, there could be a couple other red flags. All right, so let's look at an example. Almost looks like that other chart turned upside down.
Inverse of the other one.
Yep, inverse. Prior close, the horizontal line here, and R1 is up above. Gap opens well above it. Never comes close to filling. This one did attempt to fill a little bit. You can see it's a little bit of an eye chart here. It's hard to see. But you can see the first 2 or 3 candles sold off, and then that was it. It was off to the races to the upside. So for those that follow the gap, this would have been a great one to actually follow and go with the gap, targeting some predefined point or closing at the end of the day. All right, so here's that blood gap again, and we've already covered this to a certain degree, so I'm going to move through this one more quickly. Simply a gap down that is below the low of an up day. You want to be very careful because those longs will be caught off guard, and you'll have those new short sellers jumping on board. There's the data again on the ES. So I showed you the data on the S&P futures before. The Qs, again, different index, different basket of stocks. One has 100, one has 500, one's technology, one's more diversified. Yet looking back over the past 5 years, in two different time frames. The Qs, I'm only looking at data for the past 5 or 6 years versus the S&P, I went back 10 years. That was the only available data I had. Still, the numbers are remarkably the same and remarkably consistent. Leave the blood gap alone.
Yeah,
be happy that you did.
That shows you how reliable or consistent the trade is, because, like you're saying, whatever the vehicle is, the numbers are pretty similar.
And that's what you're looking for. Absolutely. Sometimes there are data anomalies, and you want to be careful. I try to double check all my data, multiple